Today, I want to take a step back and look calmly at what is really happening to your money right now. Not what it appears to be doing on paper, but what is happening beneath the surface, and more importantly, why the year 2026 creates a set of challenges for your wealth that most financial advisors are either overlooking or choosing not to talk about openly. By the end, I will also explain the one approach that has consistently protected and grown wealth through periods like this. But I should warn you up front, what I am about to share is not flashy. It is not complex. It is not built around the latest financial trend or clever strategy. In fact, many people find it almost boring. Yet it has worked for nearly a century. It has endured wars, recessions, inflationary periods, and market crashes. And it has quietly protected wealth through every major financial crisis of the modern era. Stay with me until the end, because that is where I will lay out exactly what to do, step by step, to understand why this matters. We need to start with what is actually happening to your money today. The average American currently holds about $65,000 in savings. In the United Kingdom, the typical household has roughly 17,000 pounds set aside. For most people, the majority of this money sits in traditional savings accounts, earning somewhere between 4 and 5% interest. At first glance, that seems sensible, prudent even. After all, you are earning interest and avoiding risk. But this is where the illusion begins. Over the past 4 years, cumulative inflation in both the United States and Britain has exceeded 20%. That means money left sitting safely in cash has quietly lost a significant portion of its real value. If you had $100,000 in 2020 and did absolutely nothing with it, its purchasing power today is closer to $80,000. You did not spend it recklessly. You did not mismanage it. You simply followed conventional advice and still lost the equivalent of $20,000 in real terms. This brings us to why 2026 is especially concerning. Central banks now find themselves in a difficult position. Interest rates were raised aggressively to combat inflation, but the side effects are becoming increasingly clear. Economic growth is slowing, debt burdens are rising, and political pressure to cut rates is growing stronger. When interest rates fall, the returns on savings accounts fall with them, but inflation does not disappear overnight. It lingers. That creates a dangerous gap. You may soon earn 2 or 3% on your savings, while prices continue rising at 4 or 5%. In that environment, your money loses purchasing power faster than it is today. Yet, this is only the first layer of the problem. The second issue is more subtle and far less discussed. Global currency devaluation is accelerating. Since the Federal Reserve was established in 1913, the US dollar has lost more than 96% of its purchasing power. The British pound has followed a nearly identical path. This is not theory or ideology. It is simple mathematics. Governments across the world have accumulated debt at levels that would have been unthinkable a generation ago. US national debt has surpassed $34 trillion. UK government debt has exceeded 2.6 trillion pounds. Debt relative to economic output continues to climb across most developed nations. When governments reach this point, history offers a very clear lesson. They rarely repay debt honestly in real terms. Instead, they allow inflation to reduce its burden. They let currencies lose value so that debts become easier to manage over time. Your savings are held in those same currencies. Every dollar or pound you own represents a claim on future purchasing power. When currencies are deliberately weakened, that claim slowly shrinks. I have watched this process unfold repeatedly throughout my lifetime, and the outcome has always been the same. Those who suffer most are not the reckless or the careless. They are the savers, the disciplined, the people who followed conventional wisdom and trusted the system. They held cash. They waited patiently, and over the years, they watched their purchasing power quietly evaporate. But as we approach 2026, an additional risk is emerging, and it makes everything we have discussed even more dangerous. The global financial system itself is beginning to fragment in ways not seen since the end of the Second World War. Economic cooperation that once felt stable is weakening. Geopolitical tensions between major powers are no longer abstract concerns. They are reshaping markets, trade flows, and long-standing financial relationships in real time, Supply chains that once spanned the globe with efficiency are being dismantled and rebuilt. Trade agreements that lasted decades are being renegotiated or abandoned. Economic alliances are becoming more fragile, more conditional, and more politicized. At the same time, currency wars are no longer theoretical debates discussed in textbooks. They are happening openly. Countries are actively seeking to weaken their own currencies, to gain export advantages and manage domestic pressures. When multiple nations engage in this race to devalue, there is one group that always pays the price. The people holding those currencies. I am not sharing this to create fear. I am sharing it because understanding the environment matters. Your money does not exist in isolation. It operates within a system whose rules are changing rapidly. The financial playbook that worked for your parents and grandparents is being rewritten in real time. Simply leaving money in a savings account and hoping things stabilize is not a plan. It is a passive decision with very real consequences. But this is where many people make their most damaging mistake. A mistake that has destroyed more wealth over time than any single market crash. When people grow anxious about their savings, they react emotionally. They abandon stable, long-term thinking and rush toward whatever appears to offer quick protection or fast gains. They buy speculative assets at the worst possible moment. They chase cryptocurrencies after prices have already surged. They pile into meme stocks driven by headlines rather than fundamentals. They believe promises of extraordinary returns with no real risk. In doing so, they transform themselves into exactly the kind of investor who loses money in every market cycle. This is not protection. And panic has never been a strategy. Preserving wealth in 2026 is not about discovering a hidden opportunity or perfectly timing the next market move. It is about understanding principles that have quietly protected wealth through every major financial crisis in modern history. Before I explain what actually works, you need to understand why much of the advice you are hearing right now is fundamentally flawed. The financial industry is not rewarded for your long-term stability. It profits when money moves. When you are fearful, products are sold to you. When you are optimistic, products are sold to you. When you are confused, even more products are sold to you. Most financial media exists to generate attention, not clarity. Clicks and views come from urgency and contradiction, not from patience. That is why you are constantly bombarded with opposing narratives. One expert warns of an imminent market collapse. Another promises a historic bull market. One promotes gold as essential. Another dismisses it entirely. One insists real estate is the safest asset. Another predicts a housing disaster. This confusion is not accidental. It keeps you engaged. It keeps you uncertain. And it keeps you dependent on the next piece of content, the next prediction, the next product. I have watched this pattern repeat for decades. The faces change, the instruments change, the marketing language evolves, but the underlying manipulation remains the same. So let me strip away the noise and focus on what has always mattered. What truly protects wealth, what has endured through inflation, recessions, wars, and systemic shifts, and what will continue to matter regardless of what 2026 brings. The answer is not a single decision or a one-time move. It is a system, a framework, a set of principles applied consistently over time. There are four essential components to this system. They are interdependent. Ignore any one of them, and the others become weaker. But when all four work together, you will enter 2026 better positioned than the vast majority of people around you. Let me start with the first component, and it is the one most people underestimate or ignore entirely. You must consistently spend far less than you earn, not by accident, but by design. This may sound almost too simple to matter, but everything else depends on it. Without this foundation, no strategy works for long. Look at the numbers. The average American household earning around $70,000 a year saves only 3 to 4% of its income. That amounts to roughly $2,000 annually. After adjusting for inflation, those savings are often flat or negative in real terms. In other words, they are running hard, but staying in the same place. Wealthy households behave very differently. Their defining habit is not higher income alone. It is a permanently wide gap between what they earn and what they spend. Savings rates of 20, 30, even 50% are common regardless of income level. That gap is not something they revisit every year. It is engineered into their lifestyle and never negotiable. As we move into 2026, this margin becomes even more important. Economic uncertainty rises. Job stability weakens. Income streams become less predictable. Those with a large buffer between income and spending retain flexibility. They can absorb disruptions. They can wait. They can act thoughtfully rather than react emotionally. Those living paycheck to paycheck have no such margin. One job loss, one health issue, one unexpected bill, and the situation becomes a crisis. Before doing anything else, you must examine your spending honestly and aggressively. Remove costs that do not meaningfully improve your life. Redirect that money toward resilience and long-term growth. But discipline alone is not enough. The second component determines whether your savings actually survive inflation over time. You must own assets that produce real returns above inflation. Cash held in a savings account is not an asset. It is a temporary holding place that steadily loses purchasing power. True assets represent ownership in productive activity. When you own a business, you own people, systems, equipment, brands, ideas, and customers, all working to create value every day. These productive assets tend to adjust as currencies weaken. Their prices, revenues, and profits rise in nominal terms as the cost of everything else rises. Imagine the dollar loses half its value over the next 20 years, which history suggests is entirely plausible. Prices double. A product that sold for $100 now sells for $200. Company revenues rise. Profits follow. Share prices adjust. Ownership preserves purchasing power. Idle cash does not. This principle explains my lifelong focus on owning pieces of strong businesses, not because of any single forecast, but because productive assets remain the most reliable store of value humans have ever created. For most people, the simplest path to ownership is through low-cost index funds that track broad markets. You do not need to select individual companies. You do not need to predict short-term movements. You simply need broad ownership and patience. Still, ownership alone does not solve every problem. The third component exists for moments of chaos. You must maintain strategic liquidity for both emergencies and opportunity. I have always held cash, even knowing its long-term weaknesses, not because cash is attractive, but because it provides options when others have none. Market downturns create rare opportunities. Strong businesses go on sale. Valuable assets become available at discounts. But these moments are useless if you lack liquidity. The same is true in personal crises, job disruptions, medical events, unexpected obligations. These require immediate access to funds. Investments cannot always be liquidated quickly or efficiently. I recommend maintaining at least 6 months of essential expenses in fully accessible form. This money is not an investment. It is insurance. It is flexibility. It is emotional stability. Yes, inflation erodes it slowly. That is the price of optionality. And it is worth paying. Yet, even these three components fail without the fourth. The final component determines whether any of this actually happens. You must remove yourself from day-to-day decision making and automate the entire system. Humans are poor financial decision makers. We are emotional. We are inconsistent. We react to headlines. We hesitate when we should act and act when we should wait. Every long-term study of investor behavior shows the same result. People buy late. They sell early. They chase performance. They panic during downturns and become reckless during booms. The solution is not willpower. It is structure. Automate transfers from income accounts to savings and investments immediately. Choose allocations once based on principles, not predictions. Then allow the system to operate without interference. Wealthy individuals are not more disciplined by nature. They build systems that make discipline irrelevant. Money moves before doubt appears. Investments happen before emotion intervenes. The plan executes quietly, month after month, year after year. So here is your practical framework for 2026. First, calculate the precise gap between what you earn and what you spend. Increase that gap by at least 10%. Cancel unused subscriptions. Reevaluate housing and transportation costs. Every dollar a pound freed becomes fuel. Second, establish tax-advantaged investment accounts. In the United States, maximize your employer-matched retirement plans and fund a Roth IRA. In Britain, use your full stocks and shares ISA. In Canada, maximize your TFSA. In Australia, consider additional superannuation contributions. Third, select simple, low-cost index funds covering broad ownership of productive businesses, total market funds, global equity funds. Keep it uncomplicated. Fourth, automate every transfer. Remove choice from the process. Let the system execute. Fifth, maintain your 6-month emergency reserve and restore it immediately if used. Revisit these principles when markets fall. Revisit them when excitement returns. Let them anchor your behavior. Storms will come, they always do, but preparation changes outcomes. Build a system now. Automate it now and move forward knowing your financial foundation is as resilient as it can be. That is how wealth survives uncertainty. That is how it compounds across decades, and that is exactly what I want for you.